So there are plenty of headlines out there talking about ARK's Q1 performance for this year. So today we're going to find out how ARK actually performed, and we will better understand the context and what we can expect going forward. Welcome to Big Idea Investing. It's your host, Dylan Loomis. I went through each fund and recorded the historical NAV data for each at the market open on January 4th, the first day the market was open this year, and the adjusted close NAV price on March 31st, the last trading day of the quarter. I only compiled data for the 5 actively managed ARK funds, as the 6th ARK X only recently went live. I left out PRNT and IZRL since they are indexed ETFs. Today, we want to look at ARK's active management performance. As you can see, 3 funds, ARK's flagship innovation fund, the genomics fund, and the next generation internet ETF were in the red. The fintech and autonomous and robotics ETF were in the green, and you see the 3 major US indices below for the broader market context. This actually makes for the 4th straight positive quarter for both the S&P 500 and the Dow. So this was actually a strong first quarter for the market despite the craziness of GME, the rotation out of tech, Bitcoin dominating headlines, concerns about rising interest rates, and inflation worries. Now, the Fed did say they plan to maintain rates near zero until 2023, and we did get the $1.9 trillion stimulus package paired with the central bank raising its economic growth outlook with vaccine rollouts and stimulus optimism. So it's widely known that rising interest rates disproportionately will affect high growth tech companies, which is of course a huge part of ARK's portfolios. But despite these concerns, we saw over $5 billion of new inflows into ARK K in Q1. And of course, I want to remind you all, if you plan to invest in ARK, you need to have a long-term time frame, preferably 5 to 10 years. Disruptive innovation takes years to play out, and there will be many short-term headwinds that have a big impact on ARK's quarterly performance, like interest rates rising and sector rotations that do not fundamentally impact these technology companies. And I've said it before, but if you are someone who is chasing ARK's historical performance, you are going to end up disappointed, especially in quarters like this. And you need to remember, these sector rotations can change very quickly.
Yeah, I mean, it's been a kind of a quiet week. I think everybody's waiting for earnings, to be honest with you, myself included. But the big story is, under the surface, since the beginning of the second quarter, we have seen a massive rotation back to growth, back to tech. I think a lot of that is because they got very oversold. I mean, some tech stocks were down 20-30% and been big laggards in the first quarter. I mean, if you think about it, the XLK Technology Index is up about 7% year to date now, even with the rise this week. But the XLE, the energy sector, is up 28%. The XLF is up 18%. Even the industrials are up 13%. So that was the place to be in the first quarter. You get a little bit of mean reversion now. Let's see what earnings bring and the reactions to earnings. That's always a huge tell. I'm glad that kind of financials have because they start earnings season next Wednesday. I'm kind of glad that they're sitting here a little bit. They've had a nice run, but I'm glad they didn't really just, rocket ship higher into the prints. So we'll see I think the setup is better. We'll see how the reactions are. But, Sarah, I've talked about this a lot. I think the economy is getting better. We cite data points all the time, each week. And I'll do it again because I do think that it's important to know that there are some real pockets of strength in this economy. It's really going to lead to better GDP and better earnings, little more inflation, little bit higher interest rates. That's the recipe for value. But the data points this week, ISM services at a record high, including new orders, and consumer pretty healthy. I know the low-end consumer is not, but there's a lot of parts of the consumer that is doing very, very well, especially if you look at confidence, if you look at the revolving credit. Revolving credit rose for the first time in 5 months, but it's still down 11%. That speaks to potential pent-up demand down the road. And then if you look at the savings rate, we've talked about that. 20.5% is way too high. It's not staying that high over time. And that's another actionable point of pent-up demand potential, if you will. So I still like the cyclicals. I own some tech, but I lean much more on the cyclicals because the economy has some momentum behind it.
And a lot of the market performance in the near term will be driven by valuations. And here are some key things to watch for and some of the bigger short-term catalysts as we head into quarter one earnings season.
Another day, another record high for the S&P 500. There's got to be a point where you are at least somewhat worried about valuations.
Not when bond yields are still this low, not when credit spreads are this high. And frankly, in our forecast, we've got a 4,500 year-end S&P 500 target. I don't need the PE to expand to get there. We're going to generate 20, 25% earnings growth this year. So, we'll grow into the multiple. And in fact, we expect the multiple to be flat this year, not necessarily get any more expensive. But when you look at how low bond yields are, when you look at how tight credit spreads are, stocks aren't all that stretched versus historic valuations.
Steve, bond yields are, yes, relatively low, but they're higher than they were 3 or 4 months ago, 5 months ago, yet the markets are at record highs. Take us through the math. I mean, the capital asset pricing model, risk models, interest rates are rising. Why aren't valuations falling?
Because spreads have also compressed. So our work has suggested over the years that it's actually not the 10-year yield or their treasury bond that determines the valuation on stocks. It's corporate bonds. And so, yes, the 10-year has risen, but spreads have compressed. So overall, if you were to look at where the corporate bond yield is today, it would suggest the market could trade as high as 24, 25 times. We don't expect that it necessarily will, but it's consistent with those levels of valuations. You got to look at both spreads and yields.
All right, so if those valuations are somewhat justified in your opinion at these levels right now, we are entering yet another catalyst-filled season. Yes, it is earnings season once again. Next week, we've got the big banks kicking things off. What exactly then would you be looking for from a fundamental standpoint about stocks and these companies? What are they going to report? What do they need to report in order to maintain this kind of upward trajectory for stocks?
Yeah, look, I think the first and the most important thing is once we get first quarter earnings starting next week, it's going to become apparent very quickly that the earnings recession is over, that we're no longer in a position of having year-over-year earnings declines. Part of that's just the comps from last year. But more importantly, it looks like we're going to start growing earnings this year 20, 25%. And in particular, what we're looking for in this first quarter, yes, but more so even in the second quarter in July, is the value cyclical stocks should generate ridiculously good year-over-year earnings growth. I'm talking 200+%. And we think the relative differential there versus the growth can propel these value cyclicals to one more, really good period of outperformance here over the next couple of months.
I mean, it's all relative, right? This is like the definition of easy comps at this point because things were just so bad last year at this point here. If you take a look at the way that things are playing out, are there places in the market right now that you would key on as being key drivers of that big move? A lot of people argue, and maybe rightfully so, Steve, that the earnings optimism is already priced into stocks that have gone up the way that they have over the last 6 months, especially in value cyclical.
Yeah, I think there's an understanding that these parts of the market are going to do well. I think, there's the old Mike Tyson line, everyone has a plan until they're punched in the face. And so, what's the punch in the face that I think comes this summer? I think this summer is going to be something like a modern day GI's returning home moment in a lot of ways. And so when you look at consumer comfort and even just going to a restaurant, maybe it's 50%. When you look at reopening, there's still several big states, California, New York, that really haven't reopened to the same kind of extent that Florida and Texas may have. And so I think you're going to be surprised at quite how strong the consumer comes back this summer. I think you're going to be quite how strong, how robust earnings and GDP growth is. And I think the market may not have that totally priced in just quite yet.
Really quickly, do you have a favorite sector out there right now?
Anything related to people leaving their home and spending on experiences. So think about things like consumer services, restaurants, hotels, casinos. I know they've run. They're big percentage moves, but they're coming off of a very low base.
And honestly, I could not agree more with the last bit of what Steve said. I think there is going to be huge pent-up demand for society at large once things get back to a sense of normal, and this will have big effects on earnings as we head into the back half of 2021. Some things to keep an eye on for sure. So yes, ARK did not outperform the market in Q1 of 2021, but if you are expecting them to outperform every single quarter, then with all due respect, I encourage you to study the stock market more and adjust your expectations for investing in ARK funds. I plan to make these quarterly update videos to help us learn and to stay in the know along the way, but ultimately what happens quarter to quarter is very inconsequential in the long run. Please take a second to like this video if you did, consider subscribing for more investing content, and I hope to see you in the next video. I hope that you have a great day. Until next time.